Hello, Professor. Today I'm going to answer the questions of the final of Finance 907. I'll immediately jump to the answers. Question 1. To start with, the theoretical basis of five-factor model should be explained. It is a dividend discount model that determines the value of a stock at a particular moment in a comparison with its potential value in the future. A practical use of this model relates to the determination of the portfolio potential from the perspective of the capital asset management, book-to-market ratio, size, profitability, as well as investments available. In general, portfolio returns are reviewed from the perspective of some factors. The first is whether the current parameters might change in the future. The second important aspect relates to greater tolerance to market anomalies, as long as the model is quite sensitive to such phenomena. Although a five-factor pricing model may result in a failure as it's unable to determine returns from stock that are classified as low averages, the gap suggests that a more accurate model can be introduced, especially in the context when low-value assets can demonstrate a rapid growth within a shared period. Hence, the consideration of human capital factor, together with five factors mentioned above, may potentially advance predictability and accuracy of multi-factor estimates of stock prices. It creates an investment opportunity for investment in non-tradable securities, as a factor of human capital describes a different perspective of potential profitability. Hence, it can be a strong attribute of market predictability and accuracy of estimates, especially in comparison with five-factor model that overlooks underpriced assets. To this end, six-factor model simply implies less for a specific asset. In fact, the variance of returns on marketable portfolio assets are not necessarily accurate. So consideration of human capital can stabilize and determine stock's potential for growing in price regardless of market conditions. On the contrary, the model still overlooks a time value of money and quality effects produced by human capital, so quantification is not always attributable to growth as well as value advancement in portfolio assets. All in all, the model is capable of sustaining a balanced prediction of stock value, especially when an estimated market equilibrium is known. Hence, a six-factor pricing model performs with much greater accuracy than CAPM, which is a five-factor model, and any other variation of multi-variance estimates. Question 4. It is evident that beating the market means reduction of all potential risks and linking efforts to any probability of outperformance. The value estimate, the value investment, and the primary course of action that should be taken. It is simply a strategy, as it requires purchase of underpriced shares of companies with overall positive portfolios. At the sufficient rate of maturity, the company provides exponential growth to its entire portfolio, thereby making relatively cheap securities grow in their value. What is more important, such as investments do not bear of risks since they are cheap, and do not represent a mainstream portfolio that is expected to grow before any other assets. Alongside with gaining value from wise investment decisions, taking opportunity from temporary market conditions is as effective component of an investing strategy aimed at beating the market. The markets are exposed to volatilities and now and then, so there is a constant opportunity to earn and selling right stock at appropriate time. As a sequence, it is appropriate to reallocate investments from one asset to another depending on the situation. Hence, the diversification of an investment should be present for a more optimal restriction of funds. Investing some additional sum of money can create passive reserve for the future, especially when such assets can start unexpected growth. Beyond a doubt, investment in funds is an important part of investment strategy. Funds are earned in one way or another, so this approach would also provide a reliable basis. Nowadays, there are many opinions that beating the market is not possible owing to a profound economic uncertainty and presence of large corporations that keep acquiring small companies, thereby accumulating magnitude of their market growth. Anyway, the strategy suggested is based on the best investment practices, so it would lead to profitable outcomes at minimal risks. Question 7. The situation of the global pandemics has affected a wide range of businesses, and particular industries and companies appear to benefit from a massive lockdown and quarantine. In this way, Activision Blizzard as a gaming company has grown by 1.96% as demand for video games increased due to widespread isolation of adults and their children at home. Such growth is explained with the fact that some industries do not have any access to profit-making activities at all. So the consumers are switch to the services and products that can be used at home. Taking these facts into account, it is possible to outline the first strategic solution of investment for the post-COVID-19 period. Allocation of funds is allocation of funds between recently matured companies and firms that have encountered a complete lockdown owing to the coronavirus pandemics. The latter course of action can be justified with the fact that consumers will surely return to the products and services that have been used prior to the pandemics. So these companies will grow rapidly again. However, it is important to also diversify such investments since excessive growth can lead to unforeseen consequences. All in all, the investment strategy should be based on the following principles. Number one, investment in recently matured assets for a short period can gain high profits. Unexpected popularity of specific services and products makes these assets grow accordingly. Thus, they can receive short-term investment once their value is likely to drop after the end of the pandemic. Number two, funding presently low-valued assets would facilitate their growth and larger yields right after the end of the pandemics. They would grow in value as soon as the quarantine ends and consumers return to their ordinary lifestyles. It means all products and services that were locked would have an opportunity to boost their stock prices owing to a wave of demand. Number three, timing for selling and purchase is hard to predict, so any viable opportunity should be taken. Still, it is difficult to project economic boundaries of COVID-19 effects, which is why any more or less adequate investment opportunity should not be overlooked. Otherwise, it is possible that it was the best one in this situation. 4. Volatility can be used for a rapid increase of prices. A rapid drop of major assets may mean that undervalued stocks would respectively grow, so it is crucial to allocate some money on making short-term as well as high-risk investments that have probability of earning much, if they manage to grow sufficiently. Number 5, lastly, large corporations are also worth investing in and purchasing at this moment. The crisis caused depreciation of numerous assets, so large market players actually trade their stocks with large discounts. It is a chance to invest in them, as the maturity ensures provision of yields after the end of the pandemic. Thank you for listening. I actually enjoyed answering the last question number 7. And thank you for this great course. I hope you meet again in a new course. Thanks, Professor.